Industry data shows that roughly 4 in 5 retail traders blow out their accounts within the first 2 years. Over a period of 5 years, less than 1% remain active and profitable. And nearly every single one of these failures can be traced to 3 specific destructive trade types. We're going to dig into these 3 trade setups that take out more new traders than any others. And you're going to see the technical picture, the psychological trap, and the precise moment the equity curve flatlines. And the goal is to install a mental alarm inside of you that triggers the second that you even consider making one of these moves. And trade number 1 is the revenge trade. Think of a trader takes an $80 loss from a poorly executed entry, right? They're angry. But instead of stepping away to reset, they double down the position size on the next trade. They believe that the market owes me. So there's no strategy. There's no defined invalidation level for the trade, just raw emotion disguised as confidence. So the price moves against them a little bit, snaps back in their favor. Now they're up $30. Get a bit of a dopamine hit, cancels the take profit. They're hoping that there's going to be more to the upside here. But seconds later, a news headline hits the wire, spreads widen, the instrument dumps, and that small gain is now a $300 loss, nearly 4 times the initial risk. So the lesson there is if you're trading from an emotional state, it's negative expectancy, right? The house, the market, always has the edge because your own psychological triggers are a heck of a lot louder than your risk parameters, right? So to avoid the trap, your trade plan must be defined on paper before you enter a trade. And if you do feel that flush of anger or that flush of anxiety, walk away for 5 minutes. 99% of revenge trades, these are born from a manufactured sense of urgency to trade. The second one is the over-leveraged sure thing. So same trader, different day. There is a textbook breakout setup on the NASDAQ micro futures, for example. Got a clear support and resistance zone, defined trend line, volume confirmation. Every single part of the strategy is validated. So they figure that 10 micro lots at 50-to-1 leverage can turn a 20-point scalp into a week's salary. But the risk management rule, 2%. But today, this trader decides to risk 10. So 20 seconds post-entry, price moves within ticks of the target, up $400. But greed, they add to the position. Then, and we've all seen this, an unexpected tweet reverses market sentiment, price free falls right through the entry point, blows past the mental stop, erases the account. The broker's risk system, this auto liquidates the position. In under 2 minutes, $5,000 is gone. So the math is unforgiving. 50-to-1 leverage means a mere 2% adverse move can trigger a total loss. So markets can, and they often do, move 2% before you can finish a cup of coffee in the morning. But you survive this environment with 2 hard rules. Cap your leverage at 5-to-1 when you're learning, and don't risk more than 2% of your capital on a single trade idea. The market's going to be there tomorrow. Your account certainly will not be if you ignore the math. Third trade, that FOMO Meme-Stock Chase. So the asset, it's already up 400%. So the trader gets that sinking feeling in their stomach, right? That fear of missing out. So they hit a market buy order at the absolute peak of the move. Minutes later, the early money, they start to take profit. Price gets cut in half. Trader doubles down, telling himself, it's a discount. But then it halves again. So by morning, the instrument is down 90% from the entry. So the position is closed for a catastrophic loss. They delete the app from the phone, no more trading, until the next shiny object appears on his Twitter feed. FOMO trades, these are a predictable cocktail. You got hype, you got manufactured urgency, you have social proof, and an eventual transfer of wealth to the early disciplined players. But the antidote is simple. If you didn't do the work before the hype, you're too late to the trade. So now your job is just log the ticker, do the fundamentals, do the technical analysis, whatever you do, set an alert at a price level that makes sense, walk away. So tomorrow's high probability setup, they always look boring compared to today's lottery tickets, but boring, that's what compounds. The FOMO play, that's going to leave you broke. So we have 3 trades. We have 3 paths to a zero account. We got revenge, we have excessive leverage, and we have FOMO. And each of these is triggered by an undisciplined emotion, anger, greed, or fear, and they all end up in the same place. But you counter these with process, a written plan before every trade entry, a non-negotiable cap on risk per trade, and a rule that if you feel urgency to get in the trade, you gotta wait 10 minutes before acting. These three simple habits are the foundation of longevity in this business. So remember, the market, it's a machine that's designed to transfer capital from the impatient to the patient. And your edge, it's not a complex indicator, right? It's your discipline. And it's your ability to remain systematic to your plan while others are acting on their impulses. I want you to consider sending this to a friend who just keeps talking about his can't lose trade. I know we all have these friends. And you might just save them their account. See you in the next video.
Everything discussed here is our opinion, and it is not to be taken as investment advice because we are not your financial advisor, nor have we considered your personal situation as your fiduciary. This presentation is for your education and entertainment only. Please review NetPick's full risk disclaimer and privacy policy.